Have you ever wondered how to analyze Forex charts? Today, you'll uncover the secrets. Forex chart analysis, my friends, is not some arcane knowledge reserved for the elite few. It's a skill that can be mastered by anyone with the right guidance, and it's absolutely crucial for successful trading. Picture this: a vast ocean of currency fluctuations with waves representing market trends. Forex chart analysis is your compass, guiding you through this ocean, helping you make sense of the waves and pointing you towards profitable trades. In this video, we're going to break down the process into simple, easy-to-understand steps. We'll explore the fundamentals, delve into trend lines, and peek into the world of technical indicators. By the end, you'll have a solid foundation in Forex chart analysis and be ready to navigate the market with confidence. Ready to dive into the world of Forex chart analysis? Let's begin. The first step in Forex chart analysis involves understanding the charts themselves. Let's break it down. Forex charts are essentially a visual representation of the exchange rates between currencies. The x-axis represents the timeline, while the y-axis signifies the price. This simple layout allows us to track the movement of a currency pair over a given period. Now let's talk about the types of Forex charts. First up, we have the line chart, the simplest form which connects closing prices over a specified period. Then there's the bar chart, a more detailed representation showing the opening and closing prices, along with the highs and lows. Lastly, we have the candlestick chart. With its unique design, it provides the same information as a bar chart, but in a visually appealing way, making it a favorite among many traders. Now that you've got a grip on the basics of Forex charts, it's time to dig deeper. One of the fundamental aspects of Forex chart analysis revolves around trend lines. Imagine trend lines as your trusty compass in the vast ocean of Forex trading. They are simply lines drawn over pivot highs or under pivot lows to show the prevailing direction of price. Trend lines are a reflection of crowd psychology, which, as we know, moves the markets. Identifying them is akin to reading the market's mind. Look for higher highs and higher lows for an uptrend, and lower highs and lower lows for a downtrend. They serve as your roadmap, guiding you to potential future price movements. Take, for instance, an uptrend line. It's like a supportive floor that price action bounces off from, indicating the continued strength of buyers. Conversely, a downtrend line acts as a ceiling that price action has trouble breaking through, revealing the dominance of sellers. Mastering trend lines can give you a significant edge in Forex trading, but there's more to chart analysis than just trend lines. Technical indicators add another layer to your Forex chart analysis. Think of them as mathematical assistants, whispering predictions of future price movements in your ear. For instance, moving averages smooth out price data to reveal potential trends. Or consider the relative strength index, the RSI, which gauges whether a currency might be overbought or oversold. These are just a couple examples of how indicators can illuminate your path. Technical indicators can be incredibly useful, but remember, they're just one piece of the puzzle. So you've taken your first steps towards mastering Forex chart analysis. What's next? Well, it's time to recap. We've explored understanding Forex charts, analyzing trend lines, and using technical indicators. Now it's over to you. Practice makes perfect, so dive in and start analyzing those charts. To make things easier, check out KOKOSHELL.com for the best expert advisors for automated Forex trading and Metatrader 4. Remember, the key to successful Forex trading is continuous learning and practice. So keep analyzing, keep learning, and most importantly, keep trading.